Hello and welcome to our channel. If you're a retiree or approaching retirement, then you may be wondering how to invest your money to secure your future. Today, we'll be sharing 5 investing tips for retirees. Retirement is a time for relaxation and enjoying the fruits of your labor. However, it is also a time to ensure that you have enough financial resources to sustain your lifestyle. One way to do this is through investing. Investing can be a great way to grow your retirement savings, but it can also be risky. As a retiree, it is important to invest wisely to minimize risk and ensure steady returns. In this video, we will discuss 5 investing tips for retirees to help them secure their financial future. 1. Diversify your investments. Diversification is key to reducing risk and ensuring steady returns. As a retiree, you want to protect your assets and avoid putting all of your eggs in one basket. Investing in a mix of stocks, bonds, and mutual funds can spread out your investments and minimize risk. Diversification can help ensure that your portfolio is not overly exposed to any one asset or industry, reducing the impact of market fluctuations on your investments. Stocks. Stocks are a popular investment option for retirees looking to diversify their portfolio. Stocks represent ownership in a company and can provide returns through price appreciation and dividends. However, stocks can be volatile and subject to market fluctuations. Retirees should consider investing in a mix of large-cap, mid-cap, and small-cap stocks to diversify their portfolio and reduce risk. Bonds. Bonds are a debt instrument that pays a fixed rate of interest. They are typically considered a safer investment than stocks because they are less volatile. However, bonds are subject to interest rate risk, which means that their value can decline if interest rates rise. Retirees should consider investing in a mix of government, corporate, and municipal bonds to diversify their portfolio and reduce risk. Mutual funds. Mutual funds are a type of investment vehicle that pulls money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other assets. Mutual funds are a popular investment option for retirees because they provide diversification and professional management. However, mutual funds are subject to fees, which can eat into returns. Retirees should look for low-cost mutual funds to minimize fees and maximize returns. 2. Consider income-producing assets. As a retiree, you may be more interested in generating income rather than growth. Income-producing assets such as dividend-paying stocks, bonds, and rental properties can provide a steady stream of income to support your retirement lifestyle. Dividend-paying stocks. Dividend-paying stocks are stocks that pay a portion of their earnings to shareholders in the form of dividends. Dividend-paying stocks can provide a steady stream of income to retirees, which can be reinvested or used to support their retirement lifestyle. However, retirees should be mindful of the risks associated with dividend-paying stocks, such as market fluctuations and dividend cuts. Bonds. Bonds can also provide a steady stream of income to retirees in the form of interest payments. Retirees should consider investing in high-quality bonds with low credit risk to minimize the risk of default. Rental properties. Rental properties can provide a steady stream of income to retirees in the form of rental income. However, rental properties can also be time-consuming and require maintenance and upkeep. Retirees should carefully consider the costs and benefits of owning rental properties before investing. 3. Be mindful of fees. When it comes to investing, there are various fees that investors may encounter. These fees can include transaction fees, management fees, and expense ratios. Transaction fees are charged every time an investor buys or sells a security, while management fees are charged to cover the cost of managing an investment portfolio. Expense ratios, on the other hand, are the ongoing fees charged by mutual funds or ETFs to cover the costs of managing the fund. While some fees are necessary, it's essential to be mindful of the fees that you are paying and how they may be impacting your returns. High fees can significantly reduce your returns over time, leaving you with less money for retirement. One way to minimize fees is to invest in low-cost options such as index funds or ETFs. These investment vehicles are designed to track a particular index or market and often have lower fees compared to actively managed funds. By investing in these low-cost options, you can minimize fees and maximize your returns. It's also important to be aware of any hidden fees that may be associated with your investments. For example, some mutual funds charge front-end or back-end loads, which are fees charged when you buy or sell the fund. These fees can significantly impact your returns, so it's crucial to read the prospectus carefully before investing to understand any fees that may be associated with the fund. Another way to minimize fees is to invest in individual stocks or bonds. While there may be fees associated with buying and selling individual securities, the fees are typically lower than those associated with mutual funds or ETFs. However, investing in individual securities requires more research and expertise, so it's essential to do your due diligence before making any investment decisions. In summary, being mindful of fees is an important aspect of investing, especially for retirees who are looking to maximize their returns and minimize expenses. By investing in low-cost options and being aware of any hidden fees, you can ensure that your retirement savings last as long as possible. 4. Plan for inflation. Inflation is the rate at which the general level of prices for goods and services is rising and subsequently, the purchasing power of money is decreasing. For retirees, inflation can be particularly concerning as it can erode the value of their retirement savings over time. This means that the money retirees have saved may not be worth as much in the future, and may not be able to cover the same expenses as it once did. Therefore, planning for inflation is an important consideration for retirees. One way to protect against inflation is to invest in assets that typically rise with inflation. These include real estate, commodities, and Treasury inflation-protected securities, TIPS. Real estate is a popular investment option for retirees looking to protect against inflation. This is because real estate tends to appreciate in value over time, and rent payments can increase along with inflation. Additionally, real estate can provide a steady stream of income through rental income, which can be particularly beneficial for retirees who may be looking for income-producing investments. Commodities such as gold, silver, and oil can also be used to protect against inflation. This is because these assets tend to rise in value during times of inflation, as they become more valuable in relation to a declining currency. Investing in commodities can be done through commodity futures, exchange-traded funds, ETFs, or mutual funds. While investing in assets that typically rise with inflation can be a good way to protect against inflation, it's important to remember that there are risks associated with these investments. For example, real estate can be subject to market fluctuations and can be expensive to maintain, while commodities can be subject to volatile price swings. TIPS, on the other hand, are subject to interest rate risk and may not keep pace with inflation if interest rates rise faster than expected. 5. Consult a financial advisor. Investing can be complicated, especially for retirees who are looking to protect their savings and generate income. That's why it's important to consult a financial advisor who can help navigate the investment landscape and tailor investments to your unique financial situation and retirement goals. A financial advisor can help retirees assess their risk tolerance and determine which investments are most appropriate for their needs. They can also help retirees create a retirement income plan that takes into account their income needs, tax situation, and other factors that may impact their retirement income. Additionally, a financial advisor can provide guidance on how to manage assets in a tax-efficient manner and help retirees optimize their Social Security benefits. They can also help retirees plan for long-term care and estate planning, which are important considerations as retirees age. When selecting a financial advisor, it's important to choose someone who has experience in retirement planning and a good reputation. Referrals from friends and family members can be a good place to start, as well as checking online reviews and conducting interviews with potential advisors. In summary, planning for inflation and consulting a financial advisor are important considerations for retirees looking to protect their savings and generate income. by investing in assets that typically rise with inflation, such as real estate, commodities, and Treasury inflation-protected securities, TIPS, retirees can help protect their purchasing power over time. Additionally, a financial advisor can help navigate the investment landscape and tailor investments to your unique financial situation and retirement goals. In conclusion, these are 5 important investing tips for retirees. Diversify your investments, consider income-producing assets, be mindful of fees, plan for inflation, and consult a financial advisor. By following these tips, you can help ensure a financially secure retirement. Thanks for watching, and we'll see you next time.